Hi, it's Brenton Garron with ETF Trends and ETF Database. Today I'm joined by Mark Carlson, Senior Investment Strategist at FlexShares Exchange Traded Funds. With the end of 2020 and the beginning of 2021, Mark, what are the key lessons learned for fixed income investors, and what are the most important aspects of their fixed income portfolios that should be up for review?
Oh, thanks, Brent. So I think there were like three key takeaways from 2020. And first off is no matter how disastrous an environment appears, and this was the lesson we learned from 2020, and as it has been in other negative return periods, it is never a good idea to panic and make rash decisions. Now while this recovery was a bit unique and it required massive central bank and government support in order to calm the markets, investors were rewarded by not selling into the illiquid market of late March and April and waiting for more information and the support to come from central banks and governments in order to calm markets and to return things to a more normal state of circumstances, given all things considered with the COVID virus. Now, also in that vein, and I think one lesson that we all learned, and this is one that we could have taken away from the great financial crisis of 2008 and 9, is that understanding and not fighting the Fed is a key lesson. This time around, the Fed really meant business when it launched its full suite of support programs for the markets. Those who panicked and doubted that the Fed would come through with these programs missed out on one of the fastest and steepest recoveries in history. Will there ever come a time when the central banks and governments won't support markets? Well, probably. But I think we've learned from this event is that never, never underestimate the power of the Fed. And then lastly, as we head into year end, I think now is a good time for all investors to review your fixed income portfolio position and get ready to rebalance for 2021 and beyond, especially in the terms of duration. The movement of interest rates over the last 12 months, the level of issuance in treasury and mortgage and corporate markets has significantly impacted durations on major fixed income securities, indexes, and funds, and is going to warrant the intention of investors.
Can you talk a little bit more to why is duration so important to expected fixed income returns?
Yeah, so this is the fixed income 101, take you back to undergrad or grad school, is that duration is the most important factor when it comes to predicting fixed income returns. Where an investor positions their portfolio along the yield curve will typically explain over 80% of expected portfolio returns in terms of their relationship to the movement in interest rates. So duration, which is expressed in years, is a measure of a security index or a fund's sensitivity to changes in interest rates. Interest rates and bond prices are negatively correlated, as a rise in interest rates results in the future cash flows being discounted at a higher rate, therefore negatively impacting the present value, or AKA the price of a bond. The longer the duration, the greater the sensitivity. Many investment grade sectors have experienced significant lengthening of durations in 2020, resulting in greater interest rate risk in investors' portfolios.
Great. Thanks, Mark. We appreciate your time as always and look forward to catching up with you again in the new year.